Okay, let's see here. Looks like that mic's working. Screen's up. Alright, so let's give this a go. Alright, welcome to the rapid version of the Liberty Tax School. This is the 2025 fall version. Still basing the information that we're going to be presenting off of the tax year 2024, because basically that was still the information that was available at the time that the slides were made. Some information was known about updates from OB3. I'll present that information as we go along. But we still present it in the 2024 year tax year, because if you take the certification test, you're going to have to pass based off of 2024 based questions. Remembering that our certification test is open book, open note, open internet, so just keep that in mind as we go through this, is that the core doesn't change. The information does, but for the most part, there's nothing new except for numbers. Everything else, as far as doing things, is the same as it has been for years. So we're going to continue on from there. Today's chapters, we're going to cover chapters 1 and 2. First thing we're going to do, though, obviously, chapter 1, some filing information. This is my contact information for you. If you need to get a hold of me, ask some questions, anything like that, I'm available. Just send me a text, shoot me an email. I'll get back to you as soon as I possibly can. I generally just, answer. I'm kind of on call all the time for Brett. I don't mind. So whenever you guys have a question, just get it to me and I'll help you out as best I can. Been doing taxes for 20 years, 15 with Liberty, 5 with Brett. Before that, I was working with another entity, still in this same position, so I've been doing this quite a long time. I also hold some bachelor's degrees from Wichita State University in business administration, and you see economics. I took economics for fun, so I had extra hours. That's where I filled it in at. I'm just kind of weird like that. As what my friend Brenda used to call, we're tax geeks. This is what makes us want to do this job and to be thorough about it. As you can see, I got a credential up there, RTRP, Registered Tax Return Preparer. Back in 2010, 2011, the IRS was trying to make it so anybody who did taxes for pay had to pass a competency exam as administered by the IRS. It turned out to be shot down in court. It was rejected based on IRS overstepped its authority according to the court, and the IRS never tried to pursue it in that form again. But by the time that ruling had taken place, I'd already passed the test, and so the IRS still does recognize that credential. When I take continuing education credits to qualify for the registered tax return, for the annual filing season participation program that the IRS has, they recognize that I had passed the test, so I don't have to take as many hours as somebody who hasn't passed the test. So, let's continue on with our day. This chapter, we're going to cover the income tax system a little bit, give you an idea what's going on. Hopefully you already have some idea. Hopefully you've filed your taxes before, have an idea. We're going to talk about some filing status, who must and who should file. Those are two different questions. And some other filing information. We want to know the principles behind the tax system, just get a basic understanding. Become familiar with the 1040, the way that it exists now. And again, who must and who should file. Just because you don't have to doesn't mean you shouldn't. And some other information as we go along here. So the United States individual income tax system is a progressive tax based on the principle of ability to pay. Theoretically, the more you earn, the higher your tax rate. Tax is levied on the annual income of individuals and married couples and is collected by the Internal Revenue Service. They like to say, think of the individual tax system as a yearly financial check-in with the government. Well, that's a optimistic view of it, let's say the least. Who pays and why? If you earn money in the United States, whether you're working a job, making money in other ways, like through investments, such as, or from rental property, you have to share a portion with the government. This money is reserved for things like roads and schools, other things like that. The system is set up so the more money you make, the higher percentage of your income to pay to the government. It says, imagine tax rates as steps on a staircase. The first few steps are low. This is where the government takes a smaller part of your income. The more you make, the higher you climb. The steps get steeper. That means the government takes a bigger part of your higher earnings. These are called tax brackets. Tax brackets for 26 basically breaks down to 10, 12, 22, 24, 32, 35, and 37%. Those are the different tax brackets for 2026. So you break into each one based on your income level, and really not going to go into that detail at this time. It's kind of outside the scope of this course. Calculate your taxable income by adding up all the money you made and then subtracting certain things like the government allows, like money you put into a retirement account perhaps, donations that you made to charity, taxes that you might have paid previously, other tax credits you might qualify for, tax deductions and credits. A deduction is like a discount on your taxable income. For instance, if you have a child, there's a standard amount of money that you won't be taxed on because you're providing for that child. Credit's even better. It's like a coupon that deducts money from your bill after your tax has been calculated. And we'll get into some of these credits as we go along. Each year, typically by April 15th, you have to fill out forms, a tax return. We're all familiar with that. So April 15th, whatever day that falls on, is typically tax day, unless it falls on a weekend or a federal holiday. Then it'll be the next business day after that. So if April 15th happened to fall on a Saturday, tax day is going to be the 17th, the following Monday. So this year, April 15th does fall in the middle of the week, so there's no extra days this year. The 15th will be the day that it's due. By the 15th, you have to file a tax return that shows how much money you made, what deductions and credits you qualified for. They compare it to like settling up at the end of the meal to make sure you've paid your fair share. I didn't write these slides, they come from corporate. If you paid more taxes than you need to throughout the year, you get money back, a refund. If you're getting a big refund based on just how much you had withheld, you need to reconsider your W-4. If you paid too little, you owe extra. You'll have to pay the government. Well, again, it's one of the things that's not necessarily the worst thing in the world. Depends on how much money you owe at the end of the year. You might need to look at redoing your W-4. Income tax is calculated on 1040 or a 1040 SR if you're a senior, so 65 or older. This helps the taxpayer to organize the income, deductions, tax credits. The information on the tax return determines the amount of tax due based on the income reported for the year and the resulting refund or balance due. Filing a tax return means completing and sending the forms and schedules by computer or by mail. The IRS really wants you to e-file. They don't like processing by mail. They don't have a big staff anymore. If you file by mail, it'll be at least 6 weeks before they process it, probably longer. Personal or individual income tax is levied on an individual's income throughout the year. Earnings from wages and salaries are combined with net income or loss from business, investments, retirement, and other sources to determine the total amount of gross income subject to tax. Then you take some various deductions and or adjustments to lower gross income before a tax rate is applied. When we're looking at tax rate, that's your tax liability amount. And then after that, tax credits to help you pay off your tax liability amount. Some credits are non-refundable, meaning that the best you can get out of that is I don't owe anything. Once I get down to 0 taxes owed, that's the end of the credit. If there's anything left over, I don't get it. Some tax credits are refundable, meaning that once I get all my taxes paid, whatever is left over, that's sent to me as a refund. Most refundable credits are used last. They try and make the non-refundable credits pay generally for as much tax as it possibly can. There are some exceptions to that, like self-employment tax. You can't pay self-employment tax with non-refundable credits. And we'll get into that just a little bit. Again, this is a rapid class. We don't go into a lot of detail on some of these things, and some of these things we're not going to talk about at all, except maybe in passing. So I do recommend that if you're basing your entry into this world off of the rapid class, it's enough to get you through maybe 70-80% of what walks through the door in the early season. But you're going to need to expand your knowledge after that by watching or taking a basic class sometime to be exposed to some of these other things and a little bit more detail on some of the things that we're going to talk about in the scope of this class. So some examples up here: single, no dependents, has a W-2, taxable wages is $60,000, standard deduction for a single person at the time was $14,600. Subtract that away from the $60,000 of income, that gives a taxable income of $45,400. You run $45,400 back to the tax table. It brings you back a tax for a single person of $5,219. That's how much they owe in tax for the year. That doesn't mean that's how much they need to send to the government, obviously. We haven't accounted for any money that they had withheld from their paycheck at this point. We're just looking at the worst case scenario. And hopefully they had $5,219 withheld. Chances are they probably in that neighborhood, unless they've really goofed up their W-4. Another example: head of household, 3 qualifying children, W-2. Here's $60,000 again. But this time, the standard deduction for a head of household is at $21,900. Subtract that away from the $60,000. That gives you a taxable income of $38,100. You run that back to the tax table. It comes back with a tax of $4,244. You also qualified for the child tax credit. That's what CTC stands for up here. That's a non-refundable credit. It paid for all of the tax. Now, child tax credit is a non-refundable credit, and most non-refundable credits, that would be the end of it. But we have the additional child tax credit. So it helps you get some of the tax credits that you may have qualified for children, for child tax credit, that that go beyond the scope of the non-refundable part. So it still gives you a chance to get a refund off of non-refundable credit. Child tax credit in this case, $1,756. Since that is a refundable credit, that means that $1,756 is what the refund is. Barring there's some other information on here that might be missing. Like, for instance, we have no idea what the taxes were withheld. So we have no idea. I mean, chances are they probably did have some taxes withheld, so should be a little bit more refund than what we're showing here. But this is to give you an idea. Excuse me. Income tax is calculated on a 1040 or 1040 SR for senior citizens. Taxes collected as a pay on your as you earn basis during the year. That's why you have money withheld from your paycheck every time that you get paid. Some of it goes off to pay your taxes. Pay as you earn. It's by law. By law, you have to pay 90% of what you owe at the end of the tax year throughout the year. If you underpay, you're subject to an underpayment penalty. So, no big deal when you're working for somebody else. They're doing it for you. They're withholding it for you. They're sending it off to the government for you. You got it covered. If you're working for yourself, that's a whole other problem. That's where quarterlies come in. If you're working for yourself, nobody's withholding that tax. And you're still required to pay as you earn. So, every quarter, you need to send in some money. You either base it off of what you're doing right now, or you can base it off of what you were looking at last year. Take what you owed in taxes last year, divide that by 4, send that in 4 easy payments. At the end of the year, we use the 1040 to reconcile what you earned, what you had withheld, and what you owed. And hopefully you're getting a refund. Everyone files a 1040 or a 1040 SR. There's no other forms. There's not a 1040A. There's not a 1040 EZ. Hasn't been since 2017. 1040, 1040 SR have numbered schedules, A, B, C, etc. Many people only need to file a 1040 or a 1040 SR. More complicated returns may require more or one of the accompanying schedules. Each schedule has a number on it called attachment sequence up in the upper right. There, you look at that. If you're doing it paper, that's where you'll be putting it in order. They give you an order for attaching it if you're mailing in a paper return. But we're looking at it from this point of view. And just because I qualify for a 1040 SR and I send it on a 1040, it's no big deal. That's not a wrong answer. That's an acceptable. You can do that. But if you're not 65, you use the 1040 SR, yeah, you're going to have a little problem with the IRS. You're not supposed to do that. 99.9% of individual taxpayers use the calendar year as their tax year. January 1st through December 31st. So taking a look at our 1040, and we're going to be coming back to this throughout the course of this class. Right now, we're just looking at the top part of it. Overview of the tax preparation process, introduce you to some of the terms, concepts needed to prepare a tax return. We're going to look at the sections of the 1040, and we're going to talk about the different lines and what we need to fill out. So we're looking at the top of the 1040 here, excuse me, and we see the taxpayers, in this case, that would be the taxpayers, first name and initial, last name, social security number. Gotta have that social security number. If the client has an individual tax identification number, also known as an ITIN, you'd plug it in here. Same goes down here if they're married. Whether or not they're filing together, that's a different question at the moment. If there is a spouse, that name goes here, last name goes there. Again, social security number or ITIN goes in the social security field. Home address. Try and get the home address. I mean, P.O. Box is a P.O. Box. That's fine. But any correspondence that's coming back from the IRS is going to go to the most recent home address on file. So make sure that you update it every year. That way, make sure it follows with them. And if you're sitting down with somebody, it's like, well, yeah, I'm still living it there, but I'm going to move in a couple of weeks. You might consider putting in that new address instead, especially if they already have it. That way, if any correspondence comes from the IRS, it'll go straight to them, not have to go through any forwarding orders or anything like that. So home address, number, street, P.O. box, apartment number, city, town. If you have foreign addresses, put that in below. I do have some clients that are foreign. I have some Canadians. I have some people who live in the United Arab Emirates that I tax returns for. I have to fill in that section here. Next, we're going to look at filing statuses, which is a chapter, I believe it's the next chapter. We're going to go into more detail. You have to mark one of these boxes, whether they're single, even if somebody else could claim them as on somebody else's return. You're still going to mark one of these boxes. We have single, we have married filing jointly, we have married filing separately. We have head of household, we have qualified surviving spouse. Again, we're going to go into more detail of these future. Just a general question here, digital assets. Did you participate in any Bitcoin or any other currency like that? Yes or no? On the standard deduction, somebody can claim you as a dependent or your spouse as a dependent. That's just a question. If they can't, you leave it blank. And then down here, your age and your ability to see gives you a little extra standard deduction. We'll go into that in more detail. If you're over 65, you get a little bit bump up in your standard deduction. If you're blind, again, you get a little bump up in your standard deduction. Same goes with your spouse. The spouse is over 65. Again, another bump up. If they're blind also, another bump up. You can have 4 bump ups on one tax return. So like we said, we enter the taxpayer's name, current address, social security number, whether it's a social security number or an ITIN. Same goes for the spouse. And the numbers must match what you have on file at the Social Security Administration. If it does not, you're going to reject. And it'll come back that it's rejected. If you know where to look in Fusion, it'll tell you exactly the reason why. And then you go through and fix it. So your big one in this particular area, a reason for a reject, maybe somebody just got married. They're starting to go by their married name, but forgot to tell the Social Security Administration, and they didn't change it there yet, so it's going to reject. There's a couple of fixes for that. Fix number one is just change the name here to the maiden name and resubmit. That's totally fine. That'll probably work. Or the other one is that file the paperwork with the Social Security Administration. You'll have to wait for it to clear, so give it 3 or 4 weeks, and then try it again. Filing status depends on whether you're married or unmarried as of the last day of the tax year. Whatever you are on December 31st at 11:59 p.m. is what you were for the entire year. Again, our choices are single, married filing jointly, married filing separately, head of household, qualified surviving spouse. These are important. This is where we get a little frustrated. Somebody calls up, do I have to file my tax return this year? Well, I need some information from you. First and foremost, I need to know whether or not you're filing as a single person, or as a married filing jointly person, or as a qualified surviving spouse. Because the answer to that question already begins to answer some of my other questions. If you're required to file a tax return, if you're going to get a standard deduction, and how much that is. The standard deduction is different for a single person compared to married filing jointly, compared to head of household. Tax rate. Tax rate, there's 3 different columns in the tax table if you ever look at it. There's a single rate, there's a head of household rate, and there's a married filing jointly rate. It makes a difference. And again, the last one there, eligibility for certain deductions and credits. Married filing separately, sometimes we refer to as married filing stupidly. Because if you're going to be married filing separately, you're not going to qualify for a boatload of credits. So let's talk about it. If you come in, you say you're married filing separately, and my first question is, your first question should be, why? If they come back and say, well, it's because my spouse is going to have their refund recaptured, don't do married filing separately. Look into doing injured spouse. Standard deduction, if you or your spouse can be claimed as a dependent on somebody's tax return, you were born before January 2nd, 1959, this number will change every year, whatever it takes it to become 65. Or you're legally blind at the end of the tax year, check the appropriate boxes to determine what your standard deduction is. Again, we're going to come back to this in a future chapter to go into a little bit more detail about it. If the taxpayer is blind at the last day of the tax year, request a copy of the certified statement. If they're a return client, I don't care. I mean, if I had it before, I don't need to see that form every year. It didn't change. The first time I see that you can't see better than 2200 in your best eye with correction, or that your field of vision is 20 degrees or less, the first time I see that letter is the last time I need to see that letter. After that, I already know. I already know that you can prove it. The IRS is good with consistency, if nothing else. They like consistency. So, I mean, and this can be corrected too. This does not mean that it's permanent. It could be 2200 this year, but maybe they get have some surgery and get it fixed. That's a possibility. They're getting better with that surgery, the surgeries all the time, injections and such like that. Maybe they can make it better. So I could come back in future years. You don't qualify anymore because you. But like I said, once you started qualified for this, as long as you didn't do anything to get it corrected, we're good. I'm not worried about that letter after the first time. All right, so back in 2017, there was a bill that passed, the Tax Cut and Jobs Act. It has been extended permanently. It was supposed to sunset this year, but it has been extended. It means that instead of a standard deduction and a personal exemption, which is the way it was before 2017, it's all lumped together as one standard deduction. In some cases that was better, in some cases it didn't matter, in some cases it makes it worse. If I was single, it doesn't matter. The standard deduction and the personal exemption would add up to what the standard deduction is right now. Where it kind of hurts a little bit is on married people with dependents. I, as a married person, but with no dependents on my tax return, actually benefit. I get a little bit higher standard deduction than I would have under the old way. But that's only good through the first 2.5 kids. So once you have that third kid, yeah, you're starting to be on the losing side, because no matter whether you have no kids or 20 kids, the standard deduction is going to be the same for the standard deduction is going to be the same. No matter what filing class that you're in, whether it's married or head of household, still going to be the same no matter how many kids I have on there. So there is a point where you start to lose, and I figured it out after that second kid. So that's a permanent thing. I don't look for that to go away anytime soon. Certain tests must be met to claim children or parents. A dependent doesn't have to be a child. It could be an adult. And we'll get into some of these details as we go along here. What's important, though, is that you have to have a Social Security number or a tax identification number for each dependent listed on the tax return. That column 2 can't be blank. If you have something in column 1, you got to have something in column 2, and you got to have something in column 3. There's no way around it. Going down the 1040 a little bit more, line 1 talks about wages and salaries. That's where your W-2 is going to go. 2A talks about tax-exempt interest. 2B talks about tax-exempt interest. 3A is qualified dividends. 3B is ordinary dividends. We will talk about interest and dividends in a future chapter. IRA distributions on 4A. Again, we'll talk about that in a future chapter. It's here, pensions and annuities. We're not going to go into as much detail, but they follow a lot of the same rules as the IRA distributions. Social Security benefits, they are taxable after a certain point. Again, it's something that we will talk about in a future chapter. Capital gains, kind of beyond the scope of this class. We'll mention it just in passing. Line 8 is where other income goes. The only other income that we're really going to talk about seriously is on the last day. It's going to be hobby income. That falls under this case, but that other income category covers a lot of room. If you got paid for jury duty, that goes in that column. If you sold cocaine, there is a line for illegal income. You better put it in there. Because, it's an old story, but that's how they got Capone. It wasn't over murder. It wasn't over bootlegging. It was over tax evasion. He needed to report his illegal income. I had a preparer work with me, Brenda Rolston. She did some taxes for a guy. His job was flying the snowbird. He flew in the cocaine from from other countries, landed it in a little small airstrip someplace. He reported his income as illegal income. Because, by God, they weren't going to get him for that. So we add up all the upper lines together to come up with this total income. And then we go to line 10, and we make some adjustments to income. It could be positive, it could be negative. Most of the time, we're decreasing. For instance, one of the biggest adjustments to income that you'll deal with, teachers. They get a $300 adjustment to income based on money that they spent for their classroom. That's an adjustment to income. After we do that, we come up with line 11, which is our adjusted gross income, and that's basically kind of also become our taxable income. Next section, 16 through 24, we're going to figure out what our tax is. We're going to bring them some amounts from Schedule 2. We'll go into that in a little bit more detail coming up. And then we're going to talk about refundable credits. It says subtract those away from the tax that we owe. And then we're going to add in other taxes, like for instance, again, self-employment tax would show up on this line. And that gives us our total tax. And then we come down to what they call the payment section. This is where if you paid quarterlies, it would show up in this area. If I had told them to keep my refund from last year, it would show up in this area. Money that I had withheld from my W-2 or on my paycheck shows up in this area. But there are also some other things that show up in this area that have nothing to do with money that I gave them. Earned income credit is a tax credit. It's in this area. The IRS treats that as a payment. The additional child tax credit we talked about. Again, the IRS treats that as a tax payment. American Opportunity Credit. This is a credit for getting some higher education. We're not going to talk about it in this class, but again, the IRS treats at least some of that as a payment. And we add up the total payments, and then we compare it to what you owed. Find out whether or not you overpaid, and then in this case, 34 is that overpayment, and then 35 and 36 talk about how you want that back at you. You want to send it as a direct deposit? Do you want to credit to next year's taxes? That's up to you. If you owe taxes, then we got line 37. How much I owe, and I don't care what day you actually may file the tax return, what you owe isn't due until April 15th. You can come in on January 2nd. And I can file your tax return saying that you owe $5,000. That $5,000 is not due until April 15th. It drives me nuts. Some of these people coming in here, they wait till the last minute to file their taxes because they know they owe. Why did you wait so late? It doesn't matter. Hey, you could have came in 2 months ago and found out exactly how much you owe and started budgeting for it instead of waiting to the last minute. There's no advantage in waiting. Last part, or in this section that we're talking about, signature. Whether we do this on paper, you were signing right here, or whether we're doing this electronically, something will still show up in this section. And if you have an identity protection pin, it goes in this area. Again, if you're doing this electronically, it does show up in a different area of the program, but it would end up here. PIN changes every year. And the PIN is for every filing for that tax year. So, for instance, 2026 is coming up. They're going to send an identity theft PIN here in a few weeks to everybody who needs one, who's requested one. From that point, no matter what tax year I'm doing, I have to put that pin on there, whether it's for the 25 return, the 24 return, the 20 return. I have to put that pin on there. So filing requirements, do you have to file? Well, that's an interesting question because, again, we need to look at different factors. How much money did you make? And also, where's it coming from? What's your filing status? I get into actually having to file faster if I'm single compared to married filing jointly. And again, age. If you're 65 or older, you get a little bump up in your standard deduction. So it does make a difference. Gross income includes all income in the form of money, goods, and services and property that you receive during the tax year that's not tax exempt. If you're working in a barter economy, you have to assign a dollar value to that. If I got paid in chickens, I have to tell the IRS the equivalent in income of what a chicken is. This also includes any income from sources outside of the United States. If you're a United States resident or a United States citizen, when you file your tax return, it's on your worldwide income, not just your U.S. income. Income can also be the sale of your main home, which is part of capital gains. Again, it's not something we're really going to cover in detail in this class. Gross income includes all income an individual receives in the form of money, goods, property, taxes, and services that are not exempt from tax. The specific thresholds for gross income that necessitate filing a tax return vary by filing status and age. For example, in 24, a single individual under the age of 65 must file a tax return if their gross income is at least $14,600. These thresholds are changed all the time. Every year, this usually goes up just a little bit. Just right now, so you get a little idea, since it's staring you in the face, that 14.6 is now 15,750. So it's gone from 14.6 to 15,750. Filing status of each individual significantly affects the filing requirements. Each status has a different income threshold. The filing statuses that we talk about, we have 5 of them: single, head of household, married filing jointly, married filing separately, qualified surviving spouse. Again, we'll talk about the different filing statuses in more detail in a future chapter. But single, it's kind of the worst. It's the lowest number, the highest tax rate. And as you're going along here, married filing separately also goes kind of under the single rates. So that doesn't help you very much. Qualified surviving spouse, well, it's kind of out of your control, but they get to do the married filing jointly rates, so that helps them a little bit. And then a head of household is just kind of its own thing out here. Again, we'll talk about each one of these individually. Age, again, like I mentioned, if you're 65 or older, you get a little bump up in your standard deduction. In fact, the OB3 added another 3,000. Hold on. $6,000 to the standard deduction. So it really makes a difference. So we have this table again. This is for 2024, and so like we said, so instead of 14.6 for the upcoming tax year, it's now 15.750 for head of household. Instead of the 21,900, it's 23,625, and for married filing jointly, instead of the $29,200, it's $31,500. What's that mean to you? What does that mean? Well, down and dirty, hey, as a married couple, if our income is below that filing or that standard deduction of $31,500, I don't have any taxable income. If I only made $30,000 last year, I don't have taxable income. I don't have to file a tax return. Should I? Probably. I probably have some taxes withheld. And if I had taxes withheld, considering I have no taxable income, whatever was withheld is my money. They're going to send it back to me as part of my refund. So, when you get that question, whether or not I have to file a tax return, this is where you have to go to first. First of all, you need to find out how much money they made, what their gross income was. Find out what the source of the income was, because Social Security, you'll find out when we get to that chapter, has kind of a different rule to it. It's not cut and dried. It is a little bit more complicated. But if we're just talking about W-2 income, here's the down and dirty for you. If you didn't go over as a single person $15,750, no, you don't have to file a tax return. Should you is a different question. Do you have to? No, you don't. Unless there's a few circumstances, like if you were on the Affordable Care Act. No matter what your income was, if you're on the Affordable Care Act, you have a filing requirement. I don't care if you made $0. You have to file a tax return there. Some additional considerations. Additional individuals that can be claimed on a dependent on somebody else's tax return have different filing requirements. We'll talk about that again. Self-employment income. If I have net income from self-employment of $400, I have to file a tax return. Like we said, some other certain circumstances where I have to file a tax return. Excuse me. The most important one is I'm on the Affordable Care Act. That's the most common reason. This one mentions here about special taxes like alternative minimum tax, which is beyond the scope of this class. Receiving distributions from a health savings account, well, again, maybe, maybe not. My favorite one here in IRS world, we're always running to the nearest dollar, except here, $108.28 from working for a church. If I go over that number, I have a filing requirement. And that's based on Social Security and Medicare withholdings. And so that's where it starts becoming relevant. Some churches aren't required to withhold for that, but as an employee, you're not exempt from it. So you have to pay for it somehow. You pay through your tax return. Why file even though I might not have to? I had taxes withheld. Well, if I have taxes withheld and I don't owe any taxes, whatever's withheld is my money. File a tax return, get it back. Sometimes I qualify for refundable credits, like especially if earned income credit. My income's low enough. Not only do I have not taxable income, not only do I get refund back of anything that was withheld, I actually will get more money back because I qualify for earned income credit. So their example, Tom, unmarried, lived alone, marriage status is single. He's 35. Made $11,985. He also had a part-time job. He received $2,000. That gives him a gross income of $13,985. That's below the standard deduction. Does Tom have to file this year? No, he doesn't have to. Should he? Well, I need more information. Let me see your W-2s. Let's see what you had withheld, if anything. I could set this up. I mean, you can fill out your W-4 in such a way that he knows he's not going to owe any tax. He could set it up with no withholdings, and be right. So maybe, just maybe, don't know. I need more information, and that's always kind of always what you're looking for. Can I answer your question, or do I need more information? And a lot of the times you're going to need more information. Yes, but. Bob's 65th birthday was on January 1st. He's going to be considered 65 for the entire year. Emily's 67th birthday, so they're both retired. Pension $18,779.50 in interest and dividends. Married filing jointly. Since he turned 65 on January 1st, he's going to be considered 65 for all of 2024. Gross income is $25,950. They don't have to file a tax return because the standard deduction plus the little bump ups for being over 65 push their standard deduction for 2024 up to $32,300. They didn't get there. They don't have to. Should they? Again, need more information. I need to look at, let's see here, you got a pension. I need to look at your 1099-R to see if anything was withheld. Joe, married, has not lived with his wife for 2 years. Child lives with Joe. He's going to be considered head of household. He made $21,900. Standard deduction for head of household. Excuse me. He made $16,250. Standard deduction head of household is $21,900. Does he have to file a tax return? No, he doesn't have to. Should he? Yes. Because at that income level with a dependent, he's going to qualify maybe, because we don't have enough information here. I don't know how old the child is. Might qualify for child tax credit. Might qualify for earned income credit. Both of those are refundable credits. The only way you're going to get them is file a tax return. Again, does Joe have to? No. Should he? Probably. I need just a little bit more information. Filing requirements for dependents does make a difference on earned income versus unearned income, whether they're married, whether it's over 65, whether they're blind. Because even if you're could be claimed as a dependent, you still get your bump ups for being 65 or older or being blind or both. Earned income and unearned income do terms for you, but it's something that's very important. Earned income is just that. I went to work, I made the money. Unearned income is different. Their example up here is interest income, and that's a great example. I didn't do anything. I just got paid. Money was sitting there. The money's doing the work. That's the way to look at it. Who did the work? Did I do it, or did the money do it? If I did it, it's earned income. If the money did it, it's unearned income. If I only have unearned income, a dependent does not have to file if it's less than $1,300. If their earned income is over $1,300, they have to file a tax return. If it's only earned income, they can make up to the standard deduction for a single person and not have to file a tax return. Again, should they? Probably. They probably had money withheld on their tax return. This is a good reason why we do this dependent's return for free. That way they don't go out and file a tax return for themselves, do it wrong, because most of the time they're not going to know. They're going to claim themselves a dependent. That's really going to screw over mom and dad. That's going to become a problem. That's why we do this tax return for free. We'll do the dependent's returns for free to make sure that they're done correctly. If they have unearned and earned income, we're going to look at the larger of the two numbers. $1,300 for the earned or $1,300 for unearned income, or up to $14,150 plus another $150. Don't get into that. If they stay below that level on earned income, don't have to file. Should they is another question. This slide here just talks about the bump ups, because it's not flat necessarily. Because the bump ups for the single people, as you can see right in this area, 13,250. Excuse me, that's not. That's here. That's not what I'm looking at. The difference between the $13,250 and the $1,300, or the $3,250 and the $1,300, that's your bump up. So, and like I said, the single bump ups are a little bit different than the married bump ups. Other situations where you got to file a tax return, you owe special taxes like self-employment tax, alternative minimum tax. Those are the most common types. That's here. HSA, again, self-employment tax. We talked about the church income, which is kind of an odd duck. This one right here, reason 5, you're on the Affordable Care Act. You have to file a tax return. And these other two are pretty much out there, so we're not going to worry about those. Dependent children who meet filing requirements are responsible for filing their tax return and paying any taxes that they owed. Do they owe taxes? A lot of the time they really don't. So I'm not really worried about that. But it's a great opportunity for this teenager who's just entering the job market to go through the experience of filing their taxes. Have them come in and sign the tax return. Do they have to? Not necessarily. If the child can't sign their tax return, because in this case they're not old enough, we can have the words signed by this parent signature for the minor child. I don't recommend that. I mean, it's kind of a loophole that sometimes I'm not comfortable with. The more I know the client, the more comfortable, obviously, I'm going to be with it. The child's only income is interest and dividends. The child was under the age of 19, or the child was a student full-time under the age of 24, and certain other conditions are met, the parent can elect to include the child's income on the parent's return. Yeah, not my favorite. Again, if you're looking at it, was only interest and dividends, so we could throw it on the parent's return and cover it. Does that mean they're going to exclude them? They might not see a letter in the future. You might get a letter from the IRS saying, "Hey, you should have filed a tax return, Junior," and then you got to jump through a lot of hoops saying, "Well, Junior did file a tax return, kinda. It was through their parents, and here it is." So, yeah, I just in this case, I'd just rather go ahead and file the dependent return in and of itself as a standalone. Not really a problem that we have at our offices, though. Loretta, 16, single, can be claimed as a dependent. She earned $13.01 in interest from a bank account. Well, $13.01 is bigger than 13. She's got to file a tax return. Again, the standard deduction for dependents is limited to the greater of 13 or the individual's income plus $450, but not to exceed the standard deduction for a single person. And of course, this is the IRS, so if you ever want to find a table for something or a worksheet, they've got it for you. This says Publication 17, Table 10.3 is your standard deduction worksheet for dependents. Publication 17 is the tax preparer's Bible. Anything that you need to know basically is in Publication 17. It is a big stack of paper. I do recommend that you download the PDF of it every year, because the PDF is searchable. Type in Control F on the PDF, type in your words, your hot words, and you'll come to the sections that will help you out. If you ever need a clarification on that, that's one of the places that you could go, is Publication 17. So there were an example up here. Eileen's 18, single, can be claimed as a dependent. She earned $12,850. Also received $950 in interest from a bank account for a gross income of $13,800. Under an income of $950, that's below 13. She doesn't have to file based on that. $12.50, not more than $14,600. She doesn't have to file a tax return on that. So, but a gross income of everything is larger. So, she is required to file a tax return, but that's okay. Chances of her actually owing, not that big. Tax identification numbers, there's actually 3 of them in this world. I have Social Security number. Those are issued to citizens, permanent residents, temporary residents who have been given permission to work in the United States. Individual tax identification numbers, these are available for non-residents and resident aliens, their spouses, and their dependents. And the last one, adoption tax identification number. It's a temporary number. If you're trying to adopt somebody, especially a process of legally adopting a U.S. citizen or resident child, they might not have Social Security number yet, but there is a tax return or a tax credit for adoption credit. And again, anybody that's listed on your tax return as a dependent needs to have a Social Security number. If you want to qualify for the adoption tax or the adoption tax credit, You have to have at least an adoption, a tax identification number, if you don't already have a Social Security number. Everybody on the tax return must have one of these three numbers. If they don't, the IRS will reject it, and you're at telling your client to go Social Security Administration to get a number. This is something that I talked about a little earlier. Jane Black got married this year. She's now Jane Barone. She forgot to tell the Social Security Administration of her name change, so if she files electronic using her married name, the IRS is going to reject it because they don't know who Jane Barone is. It doesn't match the Social Security number. We're going to reject. File electronically, Jane will have to notify the Social Security Administration of the name change, and when the change is made, file a return. Like I said, that's option 2. There is another option that you could get done faster. Just go ahead and file as Jane Black this year. It'll go through. There's no reason not to. It's not against any rules. As far as the Social Security Administration is concerned, that is her name. And then she could go ahead and after that, after she gets her refund back, go down to the Social Security Administration, change her name. Don't do it until after you get your refund back, but as soon as you do, take care of the business. Nobody does this. A presidential election campaign fund. This is you deciding that you want to send $3 out of a pool to the presidential election campaign fund. It has nothing to do with your refund or what you owe. It's just authorizing Congress to put in $3. Nobody has ever said, yeah, sure, let's do that. Mentioned before, April 15th is the due date. Unless it's Saturday, Sunday, or legal holiday, then it'll be the next business day. E-filing your return is considered on time if it's transmitted by the due date. There's a little exception in there. If it rejects, you got 3 days to fix it. If you mail your return, it's got to be postmarked by April 15th. If you do not file your return by the due date, you may have a failure to file a penalty plus interest. If you're unable to file your return by the due date, file for an extension. Helps you against the failure to file penalty, but it does not help you if you actually owe. If you owe and you file an extension, interest and penalties are figured back retroactively to April 15th. But filing an extension does not get you extra time to pay. It just gets you extra time to file. So, keep that in mind when people say, hey, I need an extension. And I can file an extension anytime. I can file one in January for somebody. And sometimes I do. I have some clients, I know they won't be here until June. That's the way they are. And I can file an extension for them in January. It's no problem. And if they come in, if they surprise the heck out of me and come in early, that's not a problem either. Even if I've filed for an extension. Not a problem. Oh, and by the way, failure to file penalty, underpayment penalty, late payment penalty, it's all figured on money that you owe. Hey, if you're getting a refund, there's no penalty. The penalty is you didn't have your money when you could have. But if the penalties only exist if you owed, there are no penalties if you were due a refund. Most people use a calendar year, January 1st to December 31st. I'm not really going to talk about the fiscal year part. Most people use cash method. Count it when you pay it. Count it when you get paid. I'm not going to talk about the accrual method in this class. Round to the nearest dollar. 1049 is rounded to 10. 1050 is rounded up to 11. One thing that's sure in this world is death and taxes, but just because I died doesn't exclude me from having to pay taxes. So if a taxpayer passed away before filing a tax return, somebody else has got to do it for them. If it's a spouse, pretty easy. Just go on with your day. It's really not that different. Personal representative, that's a little bit more difficult, especially if there's a refund due. We'll have to fill out a special form requesting a refund for a decedent person. But just because you're dead doesn't change anything. The same filing requirements apply to you. When filing that tax return for the taxpayer or the deceased person, we put deceased in the decedent's name when we go to sign for it. There's date of death. There's a box in Fusion for that. You just type that the person is deceased. You put in the date of death. It actually gets written across the top of the tax return. If a person representative has been appointed, that person must sign in the signature area for the decedent. So they would sign their name for deceased. If the spouse is there, we just put deceased in there, or the spouse's name, then for deceased. So that makes it easy. Filing a tax return for a refund on the behalf of the deceased taxpayer, you have to file a Form 1310. Claiming it's an easy form to fill out. Basically, it's just kind of more or less a sworn statement of the representative of the estate that they're going to do with the refund what the decedent wanted done with it. So when Mac passed away in 24, he's 40, single, gross income is $16,500. There had to be a tax return filed because he's just above the filing requirement. It's not going to be a complicated tax return, but somebody's going to have to file it for him. If you paid more than you owed, that's our overpayment, and you may be due a refund. There's different ways that you could get it. You could choose for a paper check from the IRS. Strongly unrecommended. In fact, at one point, there was discussions that was not going to be allowed at all. Some things have come up since then where the IRS has kind of softened their view a little bit on the paper check, but it's still going to take a long time. 6 weeks minimum to get a refund via paper check. Therefore, the faster way to get your money back, have it directly deposited into your bank account. Or use it as a payment for next year. Sometimes you're not going to see your money because you owe money for tax returns in a previous year, or you had a federally collectible debt, like a student loan. So it's going to go to pay that instead. Well, it happens. If you owe, it's due on the due date of the tax return, so April 15th in most cases. Pay it by then, we're fine. On our side, we want to make sure that we take care of the information that's given to us. I got a whole section of due diligence that we're going to talk about on the last day of the tax return. We are all subject to ethics as put forth by Treasury Circular 230. If it doesn't seem right to you, talk to somebody. See what should be done. And if it's unethical, hey, it's unethical. Send them on their way. Sometimes the best result for a tax return is not to do it. And that's a perfectly acceptable result. So use your discretion. If you have some questions, talk to somebody a little bit more knowledgeable. Talk to me if you have to. And we'll go over it. And we'll see what your objection is and deal with it. Like I said, sometimes the best result is no result. They left with their stuff. Great. Alright, so key ideas. Requirement to file is determined on your age, filing status, your gross income. Gross income, all income in the form of money, goods, services, property received during the tax year that is not exempt. If you can be claimed as a dependent on somebody else's tax return, there is a table in Publication 17 where you can figure out whether or not you actually have to file. But there are other conditions which might make you have to file, such as having $400 of net earning from self-employment. That means that you're going to owe some self-employment tax. Under certain conditions, even if you don't have to file a tax return, you should file because you might be due a refund because you had money withheld or you qualify for a refundable credit. Everybody on a tax return must have some sort of valid tax identification number. That's what TIN means. April 15th is generally when your taxes are due, unless it's a federal holiday, which Emancipation Day is flying around in there, so sometimes you might get 2 extra days. It just depends on how it falls. And just because you died doesn't mean you're exempt from filing your taxes. The same filing requirements apply to you. Alright, so that is Chapter 1. We are going to talk about Chapter 2, though, also today. And I'm going to take a quick break, but I really can't pause the transmission. I wish I could, but I can't. So give me about 5 minutes. So I'll fast forward about 5 minutes from here, and then we'll go forward. I'll be back in 5 minutes. So apologies if that was less time or more time than 5 minutes. I kind of forgot to hack my time, so I didn't know where I was as far as time was concerned. And I'll be honest with you, I let the dog out. She was taking her own sweet time getting back, so I apologize again if I've gone over my time. So let's go ahead and talk about our other chapter that we're going to talk about today, dependence. We have different tests to find out what type of dependent that we have. If we're talking about qualifying child, they must meet the 5 qualifying child tests. If they don't meet the qualifying child test, then we bump down to the next one. See if they're a qualifying relative. To do that, they must meet 4 qualifying relative tests. And if they don't meet that, then you don't have a dependent. Alright, so our objectives of this chapter: apply the 3 different tests to determine who is a dependent, who is not, and look at from the point of view 5 tests to see if you're a qualifying child. We'll also talk about some IRS tiebreaker rules. The understanding what the benefits of claiming a child as a dependent are. We're also going to talk about the 4 tests to determine if you have a qualifying relative. Dependents are an important part of tax returns. Most people have them. So we want to identify the correct number of dependents. Now again, based on the Tax Cut and Jobs Act back in 2017, there's no special exemption for the amount of dependents that you have. You could have 10 people, you could have no people listed on your dependents as dependents, and you'll still get the same standard deduction. Before that, there was a personal exemption. And you got a personal exemption for you, your spouse, if married, filing jointly. You got a personal exemption for everybody listed on your tax return as a dependent. No, that doesn't happen anymore. So, we're down to qualifying for credits. Examples of benefits raised to dependents include the child tax credit, the additional child tax credit, or the credit for other dependents, earned income credit, child and dependent care credit, some education credits, the head of household filing status. And we're going to learn how to apply these tests. So a dependent can be either a qualifying child or a qualifying relative. So who is a dependent? We apply the 4 tests at the top of the table. And then we look through the qualifying child test to see if we qualify that way. Or we look through the qualifying relative tests to see if we qualify that way. Always go in that order. First and foremost, find out whether you have a dependent. And then find out whether you have a qualifying child or a qualifying relative. And then go forward from there. And again, if they're not a qualifying child, they're not a qualifying relative, you don't have a dependent. Alright, so you can't, or some of the 4 tests at the top of the table. You can't claim any dependents if you can be claimed as a dependent on somebody else's tax return. Well, that makes sense. If I can't support myself, how can I support somebody else? Maybe the person who's supporting me should be qualified to claim the person that I want to claim as a dependent. Can't claim a married person who files a joint return as a dependent unless that joint return is filed, or need to claim a refund or withheld tax on income, estimated taxes paid. I'll go into this a little bit more detail a little bit farther down the line here. It took me the longest time, I'll admit, to get my head around what this actually was, and I've got a decent example for you to get you a good picture. And that just goes to show you, I mean, we're always learning in taxes. If anybody says that they know everything there is to know about taxes, they're lying. You don't. There's always something new. There's always a different way of looking at something that maybe you had a wrong take on it before. Hey, fess up to it, you know? If it's wrong before, be prepared to change your position. Can't claim a person as a dependent unless that person is a United States citizen, United States resident alien, U.S. national or resident of Canada or Mexico. That last part is a little bit deceptive. We've talked about being able to claim, or if you want to claim somebody on your tax return, they have to have a tax identification number. Well, there is kind of an exception to that, is that if they are a dependent and a resident of Canada or Mexico, you don't necessarily have to have a social security number, but really you need one because, well, I could put you on the return, it's not going to help you. Without that social security number, you're not going to qualify for any credits. And since there's no such thing as a personal exemption, you're not really gaining very much here. So I have Canadian clients. They have Canadian children, but they're I have U.S. citizens who are living in Canada, married to Canadians. They have children who are born in Canada. I don't put them on their U.S. tax return because they don't have U.S. Social Security numbers, and there's no point. I could put them on the return, but it's not going to change anything, and it's just going to make it more complicated to file the tax return. I can't even do it electronically. They would have to file a paper. But since leaving them off doesn't change the amount of what they owe or what their refund would be, there's no point in putting them on there, so I don't. Not at this point. Now, if there's a point in the future where they decide to get a social security number for them for United States citizenship, I can put them on there. Easy peasy. It's no problem. But like I said, no real good point on putting them on there right now. Even if you have a qualifying child or a qualifying relative, you can claim that to person only if these three tests are met. Dependent taxpayer test, like I said. Are you supporting yourself, or is somebody supporting you? If somebody's supporting you, you can't be supporting somebody else. Joint return test, again, put a pin on this. We'll come back to that. Citizen or resident test, basically, you have to have a social security number or an I-10 to even be considered here. If you can be claimed as a dependent by another taxpayer, you can't claim anybody else as a dependent. Well, that makes sense. Even if you have a qualifying child or a qualifying relative, you can't do the claiming. But whoever's claiming you might be able to claim them. If you're filing a joint return and your spouse can be claimed as a dependent by another taxpayer, you and your spouse can't claim any dependents on a joint tax return. Exception, if you can be claimed as a dependent by another taxpayer and you can claim somebody else as a dependent, if the person who can claim you, or your spouse, as a dependent files return only to claim a refund of income tax withheld or estimated taxes paid. So if you can file a tax return and you can claim somebody as a dependent, but you could be claimed as a dependent but weren't, there is an open door for you to try it. But we have to use some discretion on there. If your income is so low, we have to go through due diligence. Like I said, I've got a due diligence section on the last day, and one of those things is does the income look like it's enough to support everybody listed on the tax return? If not, we might need to look at some situations. Can't claim a married person as a dependent. That person is filing a joint return. Exception, you can claim a person as a dependent who files a joint return if that person and that person's spouse are able to file a joint return only to claim a refund of income taxes withheld or estimated taxes paid. So what's an example basically of somebody that might be claimed as, that might be married, might be able to file married filing jointly with somebody else, but could still be claimed as a dependent on somebody's tax return? And I'm going to paint you a picture real quick here that you could use going forward to help you out. This is not the only way that you could get to it. There are other ways, but this is the easiest example that I could think of. And we have a military couple, freshly married, and the person one's in the military, one's not. And the person not in the military, well, let's change that up a little bit. The person who's in the military is getting posted to an international post, can't take their dependent or can't take their spouses with them because it's a dangerous area. That's fine. They're left behind at home. Well, a new couple, maybe they weren't living together yet. They don't have any type of residence established. So the spouse that's staying behind still living at home with their mom and dad. Could they be claimed as a dependent on their return? Well, as we go through our tests that we're going to go through here, we can find out that maybe they could be. Excuse me. And so it doesn't make any sense. They couldn't claim, since they can't be claimed, or could be claimed as a dependent on somebody else's tax return. They shouldn't be able to file for a tax refund based on tax credits other than money you had withheld from your paycheck. Maybe mom and dad could still claim them and get a decent tax credit. And what mom and dad do with that tax credit, that's totally up to them. They might farm it back out to the dependent child. That's a totally acceptable thing, and I've had parents do that. Hey, I qualified for this tax credit based on you, so I'm going to give you a taste. But that's a joint return test. One's in the military overseas, the other one didn't make any money, living at mom and dad's basement still, because it didn't make any sense to set up a household yet. Didn't need to. The circumstances were fine. And so there's your picture. Some examples: you supported an 18-year-old child who you lived with all year while your child's spouse was in the armed forces. Just like I said, your child's spouse earned $35,000 for the year. Couple files a joint return. You can't claim your child as a dependent. Overall, they made too much money. Same facts as one, except no taxes were taken out of the wages. They file a joint return to claim the American Opportunity Credit to get a refund of that amount. Because they are filing to claim the American Opportunity Credit, they are not only filing to get a refund of income taxes withheld. Therefore, the exception to the joint return test does not apply. They must be claimed. They can't be claimed. Alright, so now we got another example, except no taxes were taken out of the child's pay or the child's spouse's pay. However, file a joint return to claim the American Opportunity Credit 124. Again, can't claim them as dependent on the tax return because they claimed a credit on their tax return. Can't claim a person as a dependent unless that person is a U.S. citizen, resident, national, or resident of Canada or Mexico. There are exceptions for some adopted children. That's where the A10 can come in. Children are usually citizens or residents of the country of their parents. If you're a U.S. citizen when your child was born, your child may be a U.S. citizen and meet the test even if the other parent was a non-resident alien and the child was born in a foreign country. Foreign students brought to this country under a qualified international education exchange program are placed in American homes for a temporary period, generally aren't U.S. residents. They don't meet the test, you might not be able to qualify for any tax credit based on that. A U.S. national is an individual who, although not a U.S. citizen, owes their allegiance to the United States. In this case, we're looking at American Samoans, residents of the Northern Marianas Islanders, like Guam, Tinian, Saipan, those who become U.S. nationals instead of U.S. citizens. Alright, so let's get down into some of the details here. Tests for a qualified child. To have a qualified child, all of the following 5 tests must be met for a child to be your qualifying child. Relationship, age, residency, support, and the joint return test. Again, we've talked about that one a little bit. We're going to focus on basically the first 4. Alright. Qualifying child relationship test. Number 1. Child must be your son, daughter, stepchild, foster child, or a descendant of any of those. Your brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of any of them. Can also be an adopted child or a foster child, as long as you have the paperwork to support your claim on the foster child or the adopted child. The adopted child in this case will always be used as a relative of yours. You signed the paperwork, you went through it, you've got it. Number 2, child must be under the age of 19 at the end of the year and younger than you or your spouse if filing jointly. Or a full-time student under the age of 24 at the end of the year and younger than you or your spouse if filing jointly. Or permanently totally disabled at any time during the year regardless of age. So if you're permanently and totally disabled and you're 30 years old and you're living with your parents still, you could still be claimed as a qualifying child. So, to reiterate that, Beth's son turned 19 on November 30th. He's not disabled, nor a full-time student. He does not meet the age test because at the end of the year, he was not under the age of 19. He is not a qualifying child. Might be a qualifying relative. We don't have enough information either way, but he's definitely not a qualifying child. You and your spouse both file a joint tax return. You're both 21. Your 23-year-old brother lives with you. And you provide more than half of his support. Your brother is unmarried, a full-time student. Since he is not younger than you or your spouse, your brother is not your qualifying child. But, again, we can look at qualifying relative. Facts are the same, except your spouse is 25 because your brother is younger than your spouse. He is your qualifying child even though he's not younger than you. So, one of you is older than him. I don't care, by how much. That's not relevant. Just as long as you can say that one of you is older, then you could do the qualifying child. Test number 2, age. For a full-time student, someone who's enrolled for the hours or courses that the school considers full-time for attendance. This is not a hard and fast number that's just out there. It's what the school considers full-time, and that might be based on their degree path. The child must be enrolled during some part of any 5 calendar months of the year and taking full-time courses. And that also includes, let's look at this, a graduating senior from high school. They would meet the test for the entire year, even if they didn't go to college. But they would still meet that test if they were 19 and was still going to high school, excuse me, January through that May. That's 5 months. They've met it. So when we're talking about enrolled, we're talking about, we could be talking about high school, we could be talking about college, we could be talking about trade school. Don't automatically think when we're talking about higher education that we're talking about college. It could be trade school. It could be VOTEC. All of those have a possibility of counting. In this case, school defined: elementary, junior, senior high, college, university, technical trade, or mechanical school. On-the-job trainings, correspondence school, school offering classes only through the internet do not count as school. So let's focus on that last one especially. They have to have a physical campus someplace. That doesn't mean that I don't qualify just because I took online courses. That's not what that says. What it says is that they have to have the ability to have in-person courses. Whether or not I actually go on that campus is irrelevant. Let's take Southern New Hampshire University. We've always seen their commercials. I could never go to I don't have to go to New Hampshire. I could take all my classes online and it'll qualify. Why? Because someplace in New Hampshire is Southern New Hampshire University. It exists. There are classes being offered in person there. They meet the requirement. Vocational high school students who work through co-op jobs and private industries as part of the school's regular course of classroom or practical training are considered full-time students. I will resort to teaching because I'm married to one. When she was getting her certificate, she had to work for a semester teaching a class full of students as part of her enrollment for her college. That's considered full-time. Even though she might not have taken any other classes that semester, she did. But even if she didn't, it's still considered full time because teaching that practical takes up a lot of time. And again, permanently and totally disabled, we throw age out the window. All we have to do, he or she cannot engage in any substantial gainful activity because of a physical or mental condition, and the doctor has determined the condition has lasted or at least will last for a year or is fatal. Doesn't mean they can't recover. I could claim my 30-year-old as a qualifying child if the situation, if he was in a body cast from the waist down. Well, he can't do anything. And he was going to be like that for the better part of this year. Or it's going to last a year. Well, hey, that's a possibility. I could claim him on a short-term basis, even though you're kind of saying he's permanently and totally disabled. Well, no, that's not kind of what that says. It just has to last a year. Let's go back to the other bullet. Cannot engage in any substantial or gainful activity. It doesn't mean that they can't do any work. Especially, you're thinking about some people that with mental disabilities, they have a job. And, you can't see me. I'm using air quotes. They have a job where they make a little bit of money to help them feel good about themselves. That's great. I'm all in favor of that. But basically, it's such a high-structured, somebody's watching their position, what they're doing throughout the day, or it's highly structured. You do this one thing. I don't have to watch you per se, because this is all you do. You know that. You do this, you put this bolt in this hole, and move it on to the next person. You can't mess that up. That's not substantial gainful activity. That's highly regulated. So, as long as we have the record of disability, they could still make some money and still be a qualifying child. Residency tests. Must have lived with you for more than half the year, but there are some exceptions. There are temporary absences that are allowed. Death or birth of a child. Hey, they didn't have to live with you for the entire year because they weren't born until December 31st. Well, guess what? You get to count them as living with you for the entire year. Which, kind of, if you think about it, is partly true. Or at least for the last 9 months, but that's over half the year. But that's not what we're looking at. We're just looking at as long as they were born by December 31st, they are counted as living with you for the entire year. The harder one, if they died sometime during the year, even if it was on January 1st, they're considered to have lived with you for the entire year. A child that was born alive and died in the same tax year will be considered as having lived with you for the entire tax year. You could claim them on your tax return. It's not the easiest tax return to do, and I'm not saying it's because it's a hard one to do. It's mentally hard on your client. I've always said, take your time. I'm about accuracy and getting it right. I'm not necessarily about getting it done fast. If it takes you 5 hours to do one tax return, we might need to talk. But, I can see where this one, you're not going to crack this one out in 40 minutes. It's going to take you some time. Whether it's a child or whether it's a spouse, be prepared to take the time. Give the time. Don't rush through it. Give them time to absorb what's going on. And I've done this tax return. I've done where we had a live birth and the child died the next day. I've done that tax return. And of course it was just last year. When you're doing the taxes, it was just last year. It's still fresh. It might not even have been a year yet since this has happened. It still could be fresh. And so take your time, use kid gloves, go on and so forth. Child kidnapped is going to consider it as live with you for the entire year, even if they weren't there at all. Children divorced with separated parents whose parents live apart. There's a little bit more to that. We'll get into the IRS rules on that one here. First and foremost, we have to look at custodial parent versus non-custodial parent. The IRS considers the custodial parent with whom the child lived for the greater number of nights during the year. So where the child slept during the year. And don't tell me that it's even, because unless if it's a leap year, 365 does not divide evenly. And the IRS doesn't accept it. One or the other gets it. The divorce is separated during the year. The child lived with both parents before the separation. The custodial parent is the one whom the child lived with the greater number of nights after that event. And I don't care what the divorce decree says. The IRS doesn't care what the divorce decree says. That's state law. This is federal law. We follow what the federal law says, because the IRS is going to say, I don't care what the state said. Who did the child live with the most during the year? That's the answer to the question. If it happens to an equal number of nights, then the next tiebreaker is going to the parent with the highest adjusted gross income. Not necessarily my favorite. Just because you made the most money does not mean you spent the most on your kid. But we've got to draw the line someplace. And so that's what happens here. So that's the next tiebreaker. First, we have the equal number of the number of nights. Then we go down to who made the most money. If the parent works at night, due to the parent's nighttime work schedule, the child lives for the greater number of days, but not nights, with the parent who works the night. That parent is treated as the custodial parent. I didn't say it was necessarily fair, but that's the way it is. Like I said, custodial parent is not established in a divorce decree. That's a federal law, or that's a state law. We're talking about tax law. Tax law is federal. It overrides. In most cases, the child meets the residency test of the custodial parent anyway. The child will be treated as the qualifying child of the non-custodial parent if all the following statements are true. The parents are divorced or legally separated under a decree of separate maintenance or divorce. Lived apart during the last 6 months of the year, whether they were married or not. Child receive over half of their support from one of the parents, or both of them. Don't care at that point. One or both of the parents had custody of the child for more than half the year, and the custodial parent signs a written declaration stating that he or she will not claim the child as a dependent for the pertinent tax year. There is a form out there, 8332, that allows the non-custodial parent to claim their child as a dependent on their tax return. That gives them access to some credits, not all credits. Not everything is transferable. We're going to learn head of household is not transferable with an 8332. We're going to learn that child tax credit, the additional child tax credit, is transferable. Earned income credit is not. The child and dependent care credit is not transferable. And here's our 8332. We have Charles and Eileen Roper. They're divorced. Ellen has custody of the child who's 6. Charles and Ellen both provided all their support for their daughter. Ellen signs an 8332 allowing Charles to claim Erica as a dependent. This form must be attached to Charles's tax return. Now, we could do this. The IRS prefers this every year that's in effect, although you can see down here in Part 3 that we could set it up for specific years. Or, excuse me, in Part 2. We can say even years, because maybe that's what the divorce decree says. This is kind of how you work around it a little bit. Alternating years. Okay, well, this is kind of what you do. You use the 8332, you set up alternating years, and the dependency and the child tax credit and the additional child tax credit go along with it, but the earned income credit, head of household filing status, can't. Parents who are never married, the special rule of divorce of separated parents also apply here. So it doesn't matter whether you're married or not. You're going to follow the same rules. Support test. Number 4, the child cannot have provided more than half of their own support during the tax year. This is an important one. I don't care if Junior made $1 million. That's not what this says. The question is who paid for everything? Examples of support we're seeing up here: housing, utilities, clothing, transportation, school, medical and dental treatment. Junior made $1 million this year, but as if it all went into a bank account and none of it was spent, he didn't provide for his own support. So mom and dad still get to claim because they're the ones who provided the support. They're the ones who paid for the housing, the utilities, the clothing, the transportation, the school, and everything else. It's not how much the dependent made, it's how much was spent. Foster care payments, so if you have a foster child, payments received for the foster child or from a placement agency are considered support provided by the agency, not by the foster child. You don't count that as support provided by the child. A scholarship received by a child who is a student is not considered in determining whether the child provided half of his or her own support. Again, we're not counting that against it. Excuse me. The child cannot file a joint return for the year unless they're filing a tax return just to get back money they had withheld from their paycheck. Again, I'm not going to go into much more detail on that. I've already kind of gave you the example of what a joint return is. We have the married couple and they're living apart for whatever reason. Somebody's still living at mom and dad's basement. They might still both be living at mom and dad's basement. That's a possibility. Times are tough nowadays. We understand that. It's more and more happening. Qualifying child of more than one person. Sometimes that happens. The child meets the test to be a qualifying child of more than one person. While the child is a qualifying child of each of these persons, only one person can get the child as a qualifying child. There's no halvesies. It's all or nothing. Sometimes you could just decide, okay, we both agree that this year you're going to do it. Next year, we'll come back to that. But if there's no agreement, if there's a fight, two people are trying to claim the same child, the IRS has tiebreaker rules. First tiebreaker rule is the IRS is considering: if one person's the parent and the other person is not a biological parent of this child, the biological parent wins. So in this case, we're talking about qualifying child. The other person might be grandpa. But if grandpa and mom are claiming, mom wins every time. Alright. Number 2, parents file a joint return together. I don't care who claims from that point. Mom and dad, again, biological parents, get to claim the child. They win. If the parents do not file a joint return together, it goes to the parent with whom the child lived with the most. Well, we've already seen that. Again, if the person who had the highest adjusted gross income, if number 3 isn't met, the person with the highest adjusted gross income for the year, their AG was higher than the highest AGI of the parent who had claimed the child. So we're looking at this last one down here is that maybe mom could have claimed, but didn't. And then 2 sets of grandparents were fighting over the child. And we're down the tiebreaker rules. Well, they're going to look at the AGI of grandparents number 1, grandparents number 2, and mom. And maybe dad. Who knows? And whoever has the highest adjusted gross income, given all other things being equal, win. But in this case, even if mom and dad, or mom/dad, or both, don't claim, but the IRS looks at the AGI of the parents, or parent, depending on the situation, and says, well, you should have. Your adjusted gross income is higher than these other two. Then, again, neither set of grandparents are going to get it. In a situation like this, you might be farming out earned income credit. This might be a fraud indicator. So this is something to watch out for. Tiebreaker rules: divorced or separated parents, basically following the same thing. But 80 through 32, Like we said, we can't sign some things over, like child dependent care credits, the exclusion of dependent care benefits, the head of household filing status, earned income credit, or things like that can't transfer. So you and your 3-year-old child Jay live with your parent all year. 25, unmarried, your adjusted gross income is $9,000. Parents is 15. Your child's other parent didn't live with you or your child. You haven't signed an 8332. So Jay is a qualifying child of both of you. Because Jay meets the relationship age, residency, support, and joint return test for both of you and your parent. However, only one of you can claim Jay. Jay is a qualifying child of anyone else, including Jay's other parent. You agree to let your parent claim Jay. It means your parent can claim Jay as a qualifying child for all 5 tax benefits listed earlier. If your parent qualifies for each of those benefits and you don't claim Jay and you only file a tax return to get back what you had withheld. This is different than the tiebreaker that we just talked about because everybody's living at the same house. Nobody's that AGI is below the filing threshold for you at $9,000. It might be more beneficial for your parents to claim Jay, and it's totally acceptable because when we're talking about tiebreaker rule number 5 back there, is that we have more people claiming this child. And we've got to figure out who's doing, who actually deserves it. In this case, we have no fight. There was an agreement. I didn't claim my child. I let my mom and dad claim the child. I'm not going to fight it. So the tiebreaker rule is not going to apply here because there's no fight. Parent has a higher adjusted gross income than the grandparent. You look at example 1, except my GI now is $18,000. I can't let Jay be claimed by my parents. But like I said, my filing example has changed. I still not have a filing requirement because I might be looking at I'm filing a head of household. We know that our head of household filing exemption is up to $23,000. I don't have a filing requirement, but I might want to. I'm going to qualify for earned income credit. Even if I don't file a head of household, let's see here. If I look at this from the point of view, I might file a single. I might have a filing required that way, but it might be the better choice because it's not my house. It's my mom and dad's house, so a head of household starts to become somewhat questionable. And if you want to avoid awkward questions from the IRS, I'm not saying that you can't. Need a little bit more information, but maybe single is the way to go on this one. It's a possibility, 2 persons claim the same child. Okay, so example 1, except you and your parent both claim, well, I'm going to win because it's my kid. But I probably need to move out at that point. Taxpayers who qualify child, so back to example 1, except I'm now 18 years old and didn't provide half of my support. I'm a qualifying child of my parents still, so I can't claim Jay as a dependent because I'm a dependent myself. Another example, you, your spouse, your 10-year-old child lived together until August 2024. Your spouse moved out August, September. Child lived with you. For the rest of the year, your child lived with your spouse, the child's other parent. Child is a qualified child of both you and your spouse because they lived with you for over half the year, both ways. And because you meet the relationship age joint return test at the end of the year, you and your spouse still weren't divorced, legally separated. Yeah. You and your spouse will file separate returns. Your spouse leaves to let you treat the child as a qualified child. This means if your spouse doesn't claim your child as a qualified child, you can claim this child as a qualifying child for the child tax credit, the exclusion of child dependent care benefits. However, you can't claim a head of household because of your filing status. You're still married, and you didn't live apart for the last 6 months of the year. we'll get into that more detail when we talk about filing statuses in the next chapter. Since I'm married filing separately, I can't claim earned income credit. And since we're not divorced, I can't be single and I can't be head of household. Now there is an option here. If these two spouses can agree to file jointly, I can do that. They're still married. They still could. And I've done this tax return. They were getting a divorce. They don't even have to be in the office at the same time. That's not relevant. He dropped off his stuff, she dropped off her stuff. I did a tax return. She came in and signed one day. He came in and signed another day. He agreed to let her have all the tax refund because basically it was she had the kids and he wanted the money to go to the kids. He was a upstanding guy for that. And it was that simple. You can do that. That actually is an option in this scenario. You, your 5-year-old child, and Luna's other parent live together all year. You and Luna's other parent aren't married. Luna's a qualifying child for both of you because they're both of you are one of the parents. You're shacking up together. Everything's met. So we're going to look at adjusted gross income. Mine is 12. The other parent is 14. So the other parent should win. But the other parent has agreed to let me claim the child as a qualifying child, which in this case is going to unlock more earned income credit. It's going to be a higher number than it would be for the $14,000. I claim for the child tax credit, head of household, child and dependent care expenses if I have any, earned income credit, and the other parent doesn't claim any of those. Again, this is possible because we're living together. There isn't a fight about who's going to claim what. I don't have to file anything special. Tiebreaker rules aren't going to apply here. You and your sibling's child, Matt, lived with your parent all year. You're 25 years old. You made $9,003. Parent made $15,000. Matt's parents filed jointly, have an AGI at less than 9. Don't live with you or Matt. Matt is qualifying child of both you and your parent because Matt meets the relationship age, residency, support, and joint return test for both you and your parent. However, only your parent can treat Matt as a qualifying child. This is because they made more money. So we can kind of see where we're going on here. Benefits of claiming a dependent: child tax credit, the additional child tax credit, credit for other dependents, although this is not exclusive to claiming a child. Head of household filing status, again, that's not exclusive to claiming a child. This is just the benefit of having a dependent. The credit for child and dependent care expenses, that is age-based, though, when we actually talk about it, which kind of beyond the scope of this course. Child and dependent care expenses only go up to the age of 13. The exclusion for income for dependent care benefits, again, that falls under 3. And then earned income credit. Again, this is not exclusive to having a child. If the child is treated as the qualified child of the non-custodial parent, this is the only time that some of the tax benefits are divided, but like I said, the only thing that's divided out is the child tax credit and the additional child tax credit. The custodial parent still gets head of household, dependent care expenses, EIC. The non-custodial only gets these 2 credits. Mary and her husband lived apart for the last 6 months of the year. Mary's 5-year-old daughter, Amy, lived with her for over half the year. Therefore, Mary's the custodial, has, though, signed an 8332 allowing Brock to claim Amy as a dependent. Brock does not meet the other criteria to use the benefits under the non-custodial parent column. Then neither Mary nor any other parent taxpayer may access those items. maybe he made so much money he doesn't qualify for child tax credit. There is a ceiling to that. Signed it over, doesn't matter. You don't get it. Nobody does. Qualifying relative. There are 4 tests that must be met. First and foremost, you're not a qualifying child. Well, that makes sense. If you're a qualifying child, go that way because it unlocks a little bit more. To be a qualifying relative, we have to look at your member of household or relationship test. We must look at the gross income test. We must look at the support test. There is no age test in qualifying relative. Test number 1. Not a qualifying relative if that person is your qualifying child or the qualifying child of any other taxpayer. There is an exception to that if the taxpayer is not required to file an income tax return and either did not or will not accept to only get back refunds of monies withheld. Let's see here. The children of Canada or Mexico can be qualifying relatives. If the child does not live with you, the child does not meet the residency test. Yeah, they live in Canada. They live in Mexico. They still may be your qualifying relative. Does not have, however, if the person does not have are not U.S. citizens, have no U.S. gross income, those persons are not considered taxpayers. So they're living with your aunt and uncle in Canada. Well, they're not U.S. citizens. They're not taxpayers. So they have no right to claim this person, you're dependent on a U.S. tax return because they're not filing one. If your child is not the qualified child of any other U.S. taxpayer, he or she is your qualifying relative if the gross income tests and support tests are met. That means you're sending money back. You're providing majority support, not your aunt and your uncle. You cannot claim as the dependent a child who lives in a foreign country other than Canada or Mexico, unless that is a U.S. citizen, resident, alien, or U.S. national. So, if they're a citizen or a resident, they can live in the Philippines. That's not a problem. Derek's sons live with him, but not his qualifying child because Derek's son is 30. So he's aged out a qualifying child. Still might be a qualifying relative. I don't have enough information, but it's still in the running. Jack Single supports as member of his household his girlfriend, Mary, and Mary's 3-year-old daughter. Mary and her daughter lived all year with Jack. Mary has no gross income, and she is not required to file an income tax return. Because Mary does not have a filing requirement, did not file an income tax return, Mary's daughter is not treated as a qualified child of Mary or any other taxpayer. Jack may claim both Mary and the child as his qualifying relatives if the support test is met. Not going to help him a whole bunch, though, because he's not going to qualify for child tax credit. No relative. Not a relative. It's not his child. So, Now change example 2, except Mary had 8,000. Claim EIC. Mary is the qualifying child of another taxpayer. Mary's child is the qualifying child of Mary. So Jack can't claim Mary's child as a qualifying relative. Also, Jack cannot claim Mary as his qualifying relative because of the gross income test that we talked about. Can't claim Mary, she made too much money at $8,000. Can't claim Mary's child because Mary filed for earned income credit. Now, if Mary had just filed for withholdings, that would have been slightly a different story. Member of household or relationship test. Number 2. Must be either related to the taxpayer or live with the taxpayer as a member of the household all year. So, yes, Mary's child, not relatives. They're not related to Jack at all. So that throws this one out, but they do qualify because of this other one. They lived all year there. 2 groups of people meet these tests. Those who are related to the taxpayer. Those who are not related to the taxpayer, excuse me, but live with them the entire year. Person who passed away during the year but lived with you as a member of the household will meet the test. Same goes for a child who was born during the year. Still meet the test. You and another person are considered to live together even if one of you is temporary absence due to special circumstances, including illness, education, business. I don't like vacation, but it's there, or military service. If at any time during the year the person was your spouse, that person cannot be your dependent. You get divorced, they're still living with you. This year they can't be your dependent. No matter when the divorce was signed. This year. Next year, hey, different story. Relatives who do not have to live with the taxpayer. Child, stepchild, eligible foster child, descendant of any of them. Brother, sister, half-brother, half-sister, stepbrother, stepsister. Father, mother, grandparent, other direct ancestors but not fosters. Stepfather, stepmother, niece, nephew, aunt, uncle, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, sister-in-law. They don't have to actually live at my place. I could be... This is an example. Let's focus in on the most realistic one. Adult child supporting mom to live at mom's house. Mom doesn't make enough money. Retired, too old. Social Security just isn't cutting it anymore. So child is paying for expenses. And if they go over half of the expenses, they pay more expenses than mom does, they qualify to claim mom on their tax return as a dependent based on the qualifying relative test. Any of these relationships that were established by marriage are not ended by death or divorce. Cousin does not meet the relationship test unless live with you all year, so a cousin's too far back. Foster child's individual is placed with you as an individual placement agency by judgment or decree or any other court of competent jurisdiction, which my original Z had always begged the question of, well, then what's a court of incompetent jurisdiction? Haha, right? But it was funny. But we'll go back to the top one. Well, let's examine that bottom one just a little bit farther. Foster child, but why am I looking at qualifying relative? Because qualifying child is probably the better. I don't know how I would not be at qualifying child necessarily. I suppose there's a scenario where that might exist, but foster child is probably going to be a qualifying child. Now let's go back to the top one. Just because it was established at one point through marriage, death or divorce does not sever that tie. And I've had this before. He married a girl who had a son, and then she wanted a divorce because she wanted the party to continue on. The son didn't want any part of that and begged to stay with stepfather. She didn't want to be tied down by him, so she was fine with that. He stayed with stepfather. They got a divorce. He's still his stepson, even though even though they're divorced. It's still totally within the rules. Not a problem. Gross income test for qualifying relative. This number actually will change every year, and I forgot to look this one up for you. I think I saw it was at 5,100, but don't hold me to that. Person's gross income for qualifying relatives, they cannot make more than $5,050, or whatever the number is for the year that you're dealing with. In this case, gross income is the form of money, property, services that is not exempt from tax, as well as gross receipts from rental properties and unemployment compensation. Don't deduct taxes, repairs. To determine the gross income from rental property, we're talking about gross. Again, we're talking about gross income. Only the taxable portion of Social Security benefits is going to be considered in gross income. And if all they're receiving is Social Security benefits, then none of that money is actually going to count in gross income. Now, support's still another question. But at this point, gross income, they could make $100,000 on Social Security benefits. They're not, but they could be. That's not the relevant question. The relevant question is going to be who supported what. For gross income tests, the gross income does not include income received by a permanently and totally disabled individual at a sheltered workshop. I've already talked about this. Again, it's the same rule as the qualifying child. So that's nothing new. Back to this, the support test. Again, now on qualifying relative, it does make a difference on how much gross income one has that's subject to tax. Oversimplifying. But I'm still left at the question, okay, you made $100,000, but that was all Social Security. What actually is being taxed here? And, to throw out the first one. And then the second one, who provided majority support? To meet this test, you must provide more than half the person's total support during the calendar year. Note that the support test is different from the qualifying child. Tax-exempt income, savings, and borrowed amount used to support the person do figure into total support. Support may also include furniture, appliances, and cars if they are bought for the person's use. You bought mom a car. You bought mom a lazy boy. The one that helps you stand up. I get to count that as support that I provided. So, again, IRS has a handy-dandy worksheet for you in Publication 17. Some things that I could look at support. Food, lodging, clothing, education, medical and dental care, medical insurance premiums, recreation. Yeah, I paid for mom to get her hair done. I get to count that. Paid for her to go see the show. Get to count that. What I don't get to count is if I paid any of her income taxes or Social Security and Medicare taxes. If I paid her life insurance premiums or funeral expenses. Total support doesn't include any of those. Determine whether you provided more or half of the total support compared to all the other support for that person includes the support provided by his or her funds. Benefits provided by the state for a needy person are generally considered support provided by the state. Yes, so you are in a race with the state on this one. Payments based on the needs of the recipient will not be considered as used entirely for that person's support if it's shown on that part of the payments that was not used for that purpose. Calculate lodging using the fair rental value if there was no rent collected. The fair rental value is the amount you could reasonably expect for a stranger to pay for the same kind of lodging. So, it's easy if mom's living at her place. It's a little bit more difficult if mom's living in your basement. But you can look at it from the point of view, okay, well, I'm going to rent this out to a stranger. How much would I expect to collect from somebody renting out my basement? Fair market value. Heat and utility costs are included in the fair market value of lodging, so they're not considered separately. But lump them all together. It's not like I can't consider them. I just lump them all together. So some examples. Helen's got $2,400 in Social Security, $300 in interest, paid $2,000 for lodging, $4 for recreation, put $3 in the savings. Even though her mother received $2,700, she only spent $2,400 for her support. So anybody who wants to be claimed, who wants to claim mom, has to beat 2,400. So we look at Helen. Let's see here. Helen paid $2,400 for food, and another $1,200 for medical and dental. She beat it. You see there's $6,000 total. Mom paid $2,400. Helen paid $3,600. Helen has provided majority support. Parents live with you, your spouse, 2 other children, the house you own. Fair rental value of your parents' share of the lodging is $2,000, $1,000 for each. We have to look at an individual basis. We'll have to look at mom's point of view and father's point of view. And we find out by looking at we meet the support test for mom, but not for dad. I can claim on my tax return, mom, not dad. Dan and Debbie want to claim Debbie's mother. Again, we're looking at fair rental value of the home, food provided, utilities and phone. All these other things, clothing, doctor, beauty salon, cosmetics, travel, entertainment, gifts, all of those count. And again, the IRS does have a worksheet for you. And we're looking at some of these things. We can see that we're taking some of the household expenses, calculating for the entire year, and then dividing that by 3, so we could, or the number of people that live in the household in this case is 3, because mom is living with the children. Okay, now we know what we got to beat. So we look at this worksheet to figure out where we're at, and we find that yes, she's a qualifying relative. Don and Donette can claim mom as a qualifying relative. There are some exceptions to the support test. We have multiple support. I've been on this one too. Not one single person provides majority support, but maybe brother and sister together beat dad, and this has happened. We can allow one of the children to claim dad, and this is what happened. Actually, it was 2 brothers, and they were both providing more support than dad was. Neither one of them was providing more support than the other, but they were both beating dad. They could be claimed. One of them can claim dad as a dependent on their tax return. It's up to them to decide who. They came to a general agreement that they were going to alternate years, and that's fine. Totally acceptable. Not a problem. Then the support test of divorced or separated parents. Will be the qualifying child of one of the parents. However, if the child does not meet the requirements to be a qualifying child of either parent, they may be a qualifying relative. So Raymond and Richard each provide 30% support for Milo. I've already talked about this example. It's not a problem. So to claim a dependent, the individual must meet all the tests as either a qualifying child or a qualifying relative. Dependent is your qualifying child who would generally provide the greater tax benefits than the one who meets the dependency test as a qualifying relative. And that's the end of today's talk. I'll have another one tomorrow. I don't know exactly what time I'm going to go live. I'm looking at maybe 7:30, 7:45, but don't hold me to it. Again, everything will be available on demand at a future on this channel. Thanks for joining. I'll talk to you next time.